Welcome to today's webinar on agricultural credit conditions. I'm Haley Shenander of the Federal Reserve Bank in Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Joe.
All right, thank you, Haley, and thank you to everyone in our audience this morning. Happy to have you join us for our latest results of our quarterly agricultural credit conditions survey. We just released our report yesterday. You can find that on our website, minneapolisfed.org, and I'll just be walking through some of the kind of high-level results and a few things that maybe aren't in the article as well. Quick disclaimer before I go any further that my views are my own and not necessarily those of the Federal Reserve System. So for those who haven't joined one of these webinars in the past, I'm going to start by giving kind of a brief overview of the significance of agriculture in the 9th Federal Reserve District. It's obviously a pretty important part of our economy in the upper Midwest and north central United States. And then I'll talk about some background about what the actual survey is before I get into the survey results from the most recent quarter, just so as not to keep you in suspense. Bottom line, high-level results from the survey are we saw some decline in farm incomes, not a major decline necessarily, but after a few years of rising incomes, started to see some fall in farm incomes. However, farm finances still appear to be pretty stable if you look at some of our other credit indicators. Land values, farm land values continue to climb, and ranch and pasture land values as well. The outlook for the fourth quarter of the year for 2023 is for a further decline in incomes. I'll talk about a little bit more about kind of some of the factors behind that in a moment. But let me start with a brief background. First of all, as just a level set for when I talk about the region, I'm going to be focusing on the 9th Federal Reserve District, and you see that in the map here. The Minneapolis Fed's territory covers the states of Minnesota, North Dakota, South Dakota, and Montana, and then we also have portions of Wisconsin, as well as the Upper Peninsula of Michigan. Now, for the purposes of this survey, we cover this region. However, we don't really have any results to share from the Upper Peninsula of Michigan because this is a survey of agricultural bankers, and there isn't a large agricultural industry in the Upper Peninsula of Michigan, and so there really aren't any banks that are concentrated in agriculture there. So really, it's just those other 5 states that we're going to be kind of reviewing in today's survey results. So looking at the map, if you're familiar with our part of the country, if you live in this part of the country, you know that we are a heavily agricultural region. And you can see that when we look at a breakdown of the size of agriculture as a portion of our GDP. Now, it should be pointed out that the way that we measure agriculture in GDP statistics, GDP, gross domestic product, is our attempt to measure the value of goods and services produced by the economy in a given year. And you can see on this chart, I have just a breakdown of GDP by sector, both for the United States and then for the 9th District states, kind of summed up on the right. And you can see that as a share of our economy, it's a much larger share of the economy in the district. You might be surprised by how relatively small it still is, though, accounting only for 3.5% of output in the 9th Federal Reserve District. Just a word of explanation about GDP and how we measure agriculture for purposes of GDP. We're really only looking at production agriculture when we look at the headline GDP statistics. So really just production of commodities, animals, livestock, dairy, and other products like that. Anything that involves processing, transportation, food production, those are going to fall into other categories of GDP. So even just looking at production agriculture alone, it's about 3 times as much of a share of our economy in the 9th Federal Reserve District as it is the United States as a whole. So a pretty important industry. And obviously, once you start to look into some of the knock-on effects and the spillovers, it's an even larger part of our economy, again, measuring things like transportation and food production and things of that nature. Just to give you kind of an overview of the size of production agriculture in our region, the USDA tracks cash receipts by commodity. So that's to kind of give you an idea of the size of agriculture in our region. Now getting into the survey results, just a little bit of a word about what the actual survey is. So this is a survey that we conduct on a quarterly basis. among agricultural bankers in our region. So I want to point out that this is not a scientific survey in the sense that we're not doing a random sample of farms or farm operations in our region. It's a small group of bankers that are heavily concentrated in ag, and these are state member banks, Federal Reserve member banks, that have a large share of their portfolios concentrated in agricultural lending. And so it's not a random sample. We're polling the same banks on a quarter-over-quarter basis. So I think of it more as a poll or a panel of experts, people who are very well versed in the agricultural economy in their communities, in their regions. So they can kind of get a regular read from their customers about how their finances are doing and how the business is doing. So that's kind of what we think, the way that we think of this as being kind of an expert panel rather than a scientific survey. We conduct a survey on a quarterly basis after the month after the quarter ends. So the results I'll be going over this morning are from our third quarter survey that was conducted in October, looking at the months of July through September, so the third quarter of the year. And we had 52 bankers across our region respond to that survey. The number of banks that are our member banks that are concentrated in agriculture has been trending down over time as the industry consolidates. The bottom line from the survey is that the financial condition of agricultural operations in our region is generally stable. We are seeing falling incomes, but stable financial condition despite those falling incomes. So on a year-over-year basis, largest share of respondents told us that farm incomes were down. That's not universal. Some operations still saw their incomes increase. So it's going to vary by your region and commodity concentration. Obviously, there's a lot of variation in the region. Spending categories a little bit more stable. Capital expenditures, so purchases of buildings and equipment, those are down. Household spending, consumer spending by farm households, still up on a year-over-year basis. Not surprisingly, given the tightening monetary policy environment, interest rates are up as well. And maybe somewhat surprisingly, fairly stable loan demand. So even though incomes are down, haven't seen an increase necessarily, or at least a large increase yet, in demand for loans, for operating loans or other loans from farm operations. And repayment rates are pretty steady as well, despite the decline in incomes and the increase in interest rates. As I mentioned earlier, we've seen some continued increase in land values and cash rents as well. And the outlook for 2024 is for further declines in income. So just to kind of get into the sort of indicator by indicator breakdown of these results, again, as I mentioned, on balance, the respondents in the survey told us that farm incomes decreased, but it's not a universal decrease. So about 46% of them told us that they decreased. That was the largest share, but still 23% of operations telling us that they saw incomes increase. And again, this is in the third quarter on a year-over-year basis. So third quarter of 2023 compared to the third quarter of 2022. Just under a quarter of operations saw their incomes increase in that period. 31% of them told us that they didn't see any change on net in incomes. So the largest share telling us that they decreased. Those spending categories, you can see the capital spending sort of looks a little bit more like the income picture, where you had a larger share telling us that they saw decreases in capital spendings relative compared to increases. Largest share actually telling us, though, that they saw no change in capital spending and household spending still increasing on balance over this period. Just to kind of put this in historical context, this is a sort of a chart just showing over time the percentage of respondents that told us that they saw incomes either increase or stay flat relative to a year earlier. And you can see that we're coming off of a period of a few years of pretty strongly rising incomes, really since kind of the middle of 2020, once those sort of pandemic effects started to become a little bit more clear, we started to see pretty strong period of incomes. And now we're sort of decreasing back over the last couple of surveys, decreasing back towards something a little bit more like the historical median of the percentage of respondents telling us that they're seeing increase in incomes. So kind of looking a little bit like more like sort of historically normal rates of income growth over the life of the survey that we've been doing going back to the mid-1990s. As I mentioned, looking at some of the credit conditions that we ask about in the survey, those are actually holding up fairly stable. In particular, loan demand just about roughly equal proportions, telling us that they're seeing an increase in loan demand from agricultural customers. Is telling us that they saw a decrease. On balance, slightly higher percentage telling us increases, but the majority saying that they haven't seen any increase in loan demand, and especially repayment rates and renewal activity. Overwhelmingly, no change being reported in those. A slightly higher percentage reporting increases rather than decreases. But overall rates of loan repayment staying pretty stable, and those are coming off of a period of high incomes in which repayment rates had been increasing over time. So still a pretty high rate of loan repayment on balance, and not much of a change from that. And then those renewals as well, not much change in the rate at which farm loans are being renewed. We asked them about their outlook for the coming 3 months, so for the fourth quarter of 2023 through the end of the year. And what we're seeing is that they're expecting further decrease in incomes. Perhaps not surprising, because we know that commodity prices have been coming off of their recent peaks, and yet the operating costs of farms are still pretty high. Those input costs, we're hearing in the comments from the survey, are still pretty onerous. And so on balance, we're seeing that translate to a decrease in incomes. So most of the lenders, 60% of them, telling us that they expect a decrease in farm incomes in Q4 relative to Q4 of 2022. Again, this is a year-over-year comparison. Similar picture with the capital spending as well. Slight majority telling us they expect a decrease in purchases of equipment and buildings. And then overall, the household spending picture looking pretty flat for Q4. Some outlook for an increase in loan demand for the coming quarter, but a pretty even split between those telling us that they expect a decrease, an increase, or no change in loan demand. A slightly higher percentage, 38%, expecting loan demand to increase in Q4. This is something you might expect to see given falling incomes. There's going to be a greater need for credit by farm operations for operating loans and other usage of credit given the falling income environment, but overwhelmingly still a stable picture, expectations for repayment rates and renewal activity. So overall, the outlook for the financial indicators for farms is pretty stable, and this is consistent with what we know, that even though the cash cushions that farms have worked up over the last few years during this period of high production and high commodity prices is being worked down, they're still sitting on pretty good cash cushions. And so that's translating into a stable financial condition looking forward, at least through the end of the year. Not surprisingly, still seeing some increase in interest rates. So these are just interest rates, fixed and variable rates on a couple different categories of loans that you can see. We also ask about real estate loans in the survey. Those are up as well. So for all of these categories, both fixed and variable rates on operating, machinery, and real estate loans all increased by at least 20 basis points, or 0.2%, in the third quarter from the second quarter. And that's, of course, coming off of a period of more than a year of climbing interest rates. This is a concern that lenders are reporting. The increased cost of credit for farm operations is maybe going to have some constraining impacts going forward. You can see the pace of increase kind of leveled off in the last quarter. So it's not this sort of sharp pace of increase that we saw through 2022, but still increasing on balance, like I said, by at least 0.2% for each of these categories of loans, and in some cases a little bit more than that as well. Maybe somewhat surprisingly, given the decline in farm incomes and the tighter interest rate environment, we're still seeing pretty solid growth in land values from a year earlier. So this is just going state by state, the comparison of the average price reported by lenders for an acre of good quality farmland in their area, and this in particular is non-irrigated farmland. Across the district, the average reported by lenders was a 7% increase in Q3 from a year earlier. And you can see on a state-by-state basis, it's a little bit higher in the Dakotas than it was in Minnesota. Minnesota was 3%, the lowest of all the states. And you can see that in South Dakota is 14%, North Dakota 13%. Montana, I should caution, there's a relatively smaller number of respondents reporting in this quarter, but they told us on balance a 16% increase year over year and 6% in Wisconsin. So across the region, growth in farmland values. But at a slower rate, I should point out, than what we've seen over the last couple of years. So when I presented these results in a webinar back in May, we were seeing double-digit increases across the district in land values, and so the pace of increase is slowing, but still positive year over year. And consistent with that as well, also seeing increases in the cash rent on an acre of farmland. Again, this is for non-irrigated land in the district. 4% on average across the district increase in the rent on an acre of non-irrigated land. And again, a little bit higher in North Dakota, but fairly consistent across the region as well, coming in at about 4%, both in South Dakota and Wisconsin, in addition to Minnesota as well. So those two things are moving in the same direction. Before I finish up, I just kind of want to report on the results of a special question that we asked about on the third quarter survey. We know that the farm labor situation has been challenging for a long time for agricultural producers. So we wanted to ask a few pointed questions about this. Working on a separate article about this that's going to be coming out later in the year. Just to kind of give you a breakdown, the bottom line, when we asked lenders about how serious of a challenge securing adequate labor for farm operations is, the vast majority, as you can see, told us that it's a serious challenge, but not the most important challenge. In fact, none of the lenders who responded to the survey told us that labor was the most important challenge facing producers. About a third of them told us that it was a minor challenge, and about a little under 2/3 told us that it was a serious challenge. So you can kind of see sort of where this ranks among other concerns. It's a major concern and a constraint on operations, but not the biggest challenge that folks are facing. And making a comparison to a couple different time periods on how the farm labor market has changed recently, you can see that comparing year over year, most lenders that told us that there hadn't been much of a change in the availability of labor, but compared to 5 years ago, the majority of lenders telling us that it's gotten worse. So you can see the kind of breakdown there. 61% of lenders saying that compared to last year, the availability of farm labor is about the same, and yet compared to 5 years ago, 44% of lenders saying it's a little worse, and an additional 38% saying it's much worse. No one reporting that the situation has gotten better, either a little better or much better. Everybody's saying it's either about the same or worse, and most of them saying, at least over the last 5 years, that it's gotten significantly worse. So that's something we're paying attention to, and keep an eye on our website for a future article about that. And with that, I am going to take some questions from the audience. It looks like we have a few in the chat. Haley, I don't know if you have any that you want to call out to my attention.
Just as a reminder to participants, if you have questions, please type them in the chat box on Zoom. So we can start with this one. Is it surprising that bankers are not reporting much increase in loan demand given the decrease in incomes?
Yeah, so that's a good question. I think I think it is a little bit surprising. Superficially, you might say, gee, we know that incomes are down. You'd think that farms would need to be borrowing more in order to finance operations. But I think that one thing that's happened over the last few years is because farm operations have been so profitable, they've been building up significant working capital, and they're sort of working that down now before they actually start to borrow more. I think the other thing going on that's worth pointing out is the increase in interest rates has made sort of disincentivized borrowing over this period. So that's going to be a headwind, kind of pushing against greater use of loans. And so I think given those two factors, both the kind of the better, relatively strong cash position still, and the high interest rates, it's maybe not surprising that we've seen pretty stable loan demand.
Great. Someone else was wondering, do we see impact of federal farm program spending, sometimes called climate smart ag? Vilsack has said that the aim there is to produce new revenue streams for farms.
Yeah, I mean, I really can't comment on that in this particular survey. I think, obviously, There's a lot of different federal support programs for farming, but we don't really ask about those in the survey. I would say that there was a period sort of during 2020, 2021 where we were seeing a pretty significant impact of some of the pandemic relief programs on farm incomes. They were having a significant boosting effect on farm incomes. A lot of those have kind of waned at this point. And if you look at some of the statistics from the USDA on farm income and its sources, the share of government assistance as a portion of farm income has come down. But we don't ask about that in the survey, so I can't really comment on any particular survey results that are pertinent to that.
Great. Someone else was wondering, if rates stay at the current level, do you believe that growth in farm incomes is sustainable?
If rates stay at the current level, I don't know that those are two things that are really pushing in opposite directions. I think that you can certainly have growing farm incomes at a time of higher interest rates. Obviously higher interest rates are going to be a bit of a headwind because they're going to increase the cost of credit or interest expense for farm operations. So that is they're going to have some negative impact on income to the extent that farmers have to pay them. But on net, you could still see increases in farm income if you have strong harvests and yields, and if you have strong commodity prices. I mean, I think overwhelmingly commodity prices are going to be the biggest determinant to farm incomes.
We've got someone else wondering, what is your take on capitalization rates for farmland being so low compared to interest rates, as well as relatively safe investment alternatives such as CDs or 10-year T-bonds? Do you see that correcting anytime soon?
Boy, that's a prediction that I would have. I would be reluctant to make. I guess I will say this. Yeah, we know that because interest rates have gone up, the capitalization rates on farmland have become sort of less favorable. One thing that I'll point out, though, as I mentioned in the survey results, we're still seeing increases in rental in cash rents on farmland. Now farmland values have been increasing faster than rents. So you would hope that those come back more into line. But yeah, I'm reluctant to make too much of a prediction on a so-called sort of correction in farmland values, because again, I think overwhelmingly those values are being driven by what can be produced on an acre of farmland. I mean, there are other things that are driving farmland values. And in fact, we did have some comments in the survey. I even mentioned them in the article on our website about purchasers of farmland from outside the area, people buying recreational land and things like that, driving up farmland values as well. So those are other sort of factors that are pushing on the price of farmland. But yeah, that's about all I have to offer on that, I guess.
Going to the topic of farm labor, someone was wondering, are wages remaining static?
So that's a good question. No, they're not. And you can actually look at the USDA. The USDA does a farm labor survey that they release twice a year. They released the last one in May, and they're going to be releasing another one later this month. And you've seen, I can't quote exactly, the exact percentages, but a pretty significant increase in reported wages for farm labor across the country. So I'd pay attention to the November release when it comes out and take a look at what the wages are. But yeah, those are definitely up.
Great. And it looks like we have one more question in the chat. Someone is asking, what were survey respondents' biggest concerns?
Yeah. So actually, I would point to the interest rates. That was one thing that was really heavily pointed out. Just in the comments on the survey. Overwhelmingly, I would characterize the comments on the survey as being, concerned about essentially the environment that we're in right now. With although commodity prices are still historically speaking pretty strong, they've been trending downward, but input costs are up. And a big part of that is interest rates and interest expense. So now we're entering a period. I would say the concern is, and this is not something that I think people are reporting actually happening yet, but there's a concern going forward that we're entering a situation where incomes are coming down. That means there's going to be greater need for credit by farm operations, and at the same time, they're going to have to pay more to finance that credit, and so that's going to be kind of a further constraint on farm finances. But we're not actually seeing a significant impact from that yet. We'll see what happens when our fourth quarter survey comes out.
Great, great. Looks like that's our last question for
All
today.
right.
Yeah, thanks so much for everyone for joining us. More information will be in our follow-up email to this event. And please join us for our next virtual event, Regional Economic Conditions Constructor Sector Outlook, on Wednesday, November 29th at 9 a.m. With that, I hope everyone has a great day.
Thank you.